Welcome to the Millionaire Next Door Podcast with Robert Curtis, CFP, accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work-optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Welcome, everyone, back to the Millionaire Next Door Podcast. Again, we're so pleased that we have you here and that you've chosen to listen, and we hope this is a helpful discussion. Today, we have a special guest, and I wanted to bring up some elements that have changed in the recent tax law and the big, beautiful bill law as it pertains to opportunity zones. I've got someone who deals in that space extensively every day, Michael O'Shea. He's a certified financial advisor, CFA, director of private wealth with Origin Investments. And some things are changing. We're in a period of 2026 where this may not be that attractive, but it becomes very, very interesting from a tax deferral or avoidance standpoint as a strategy for real estate investors starting in 2027. So we wanted to bring this up, give people lots of advanced planning to have the kind of discussions. We engage in it. We can engage with your CPA or other tax advisors. But welcome, Michael. Thanks for being here.
Thanks, Rob. Great to join you. Thanks for having me on.
Yeah, 100%. So do you want to sort of launch into this, the qualified opportunity zones? This, folks should know, this is going to be like an evergreen resource. So this could be referred back to. It's going to take some time to release, but you don't want to just jump into these things. You want to have detailed discussions and coordinate with maybe your tax or legal advisors and make sure it makes sense. So we think this will be a very good resource for folks, but I'll turn it over to you since you're the specialist in the space. Yep.
Yeah, there's lots to cover on opportunity zones. So why don't I give a maybe 2-minute overview for a lot of the folks on this listening to this podcast, I'm sure have never heard of an opportunity zone. So this is essentially a tax advantage strategy that was created as part of the 2017 Tax Cuts and Jobs Act. So it's a relatively new piece of legislation, but it's extremely powerful. And it's really something that's, in my career, I've worked with investors that have sort of events in their lives where we're selling appreciated real estate and we want to do a 1031 exchange. And I've been doing that for almost 20 years. And now the opportunity zone is similar but different. Essentially, if you think about the OZ, it's kind of a public-private partnership to encourage long-term investment into areas that could use the capital across the United States. So what it says is the government wanted to encourage this investment and this growth in these so-called opportunity zones. And so they needed a large pool of capital. And so what they suggested, or what they kind of put in this law, was capital gains. So capital gains is a very large bucket for investors out there. So it's not like a 1031 where it has to be a capital gain from real estate. It's any capital gain from any source, whether you're selling stocks, whether you have company options, whether you're selling a private business, collectibles, art, but of course, appreciated real estate as well, long-term capital gains, short-term capital gains. And essentially, we could get into details down the road, but essentially you have about 6 months from the time you realize a capital gain to invest it into an opportunity zone fund. The opportunity zone fund is going to take that capital and it's going to build buildings in these markets across the United States. In our case, at Origin Investments, we focus on multifamily exclusively. So we would pool investors' capital together in this opportunity zone fund, and we would build apartment communities in Charlotte and Tampa and Dallas and Denver and Phoenix and sort of high growth markets that we focus in. So the benefit for you is really twofold. Number one, you get to defer the tax on whatever you sold today, whether it's stock or a private business. You don't have to pay that tax today. You get to defer it until later out. But then the real benefit is there's a required 10-year hold to get the full tax benefit in opportunity zone. But think about after 10 years, what this portfolio looks like. It went from raising capital to now we have a portfolio of fully seasoned apartment buildings that are now built and cash flowing. So 10 years from now, you should have hopefully a significant capital gain. That capital gain is completely eliminated. So the way opportunity zones work is after you've held them for 10 years, you get a fully stepped up cost basis. So all of your proceeds come back to you liquid, tax-free, like Roth proceeds. There's almost nothing else like it in the tax code.
Yeah, I mean, that's a very powerful tool. And thanks for sort of correcting my intro. Obviously, this can be used for folks that have other appreciated assets. So we do get referred in quite a bit to folks with very highly appreciated securities, Apple, Nvidia, Google, Broadcom. You see it all day long. What they put in and what it's worth now is unbelievable. And they may want to move away from some of that, but to get out of that certainly is one strategy to consider. There's other strategies, but this is a powerful one. So you'd be moving into some real estate, but then that cash flows, right? And produces an income, and it's passive, and you don't physically have to do anything. So is that the thinking?
Yeah. Yeah.
Uh-huh.
Think about portfolio management. Essentially, when you're a younger investor, it's all about growth. I want my assets to go up in value. And as you move along your investment life cycle, especially if you work for these companies, or if you just happen to invest in Nvidia and Broadcom and Apple, a lot of people are retiring early because of the growth. Well, what do we know about the stock market? We don't know whether Nvidia and Apple and all these companies are going to keep going up. We do know that the market is going to regress to its mean, because it always does. Over the last 100 years, it has. So if you're worried about stocks being overinflated and you want to lock in your gain, this is sort of a way where you're basically just removing that out of stock exposure in your portfolio, and you're moving it, like you said, Rob, to a more stable asset class. You're investing in real estate, which is going to give you steady cash flow. It's not going to be as volatile as stocks, and it's going to give you tax advantage income as well, because you can use the depreciation on the assets to offset your taxable income. So it's a really nice solution for those concentrated stock positions, or I've got big winners in my portfolio that I need to unwind.
Great. And then as we are here in mid to late January 2026, what kind of yields are coming off these portfolios presently? And maybe that changes going forward, but I'm just curious for people's planning.
The interesting thing about opportunity zones is that they require you to develop something from the ground up. Like we have a cash flowing portfolio right now that would generate probably around 6.5% cash flow if you put money in there today. So I think once these buildings are built, that's kind of a nice cash flow that you can expect going forward, maybe in that 6.5% range. Our portfolio right now is, I think, 98% tax sheltered last year. So it gets you what we call a taxable equivalent yield, closer to 10%.
Oh, wow.
Taxable equivalent yield just means you'd have to find a fully taxable 10% investment to equal our 6.5% tax advantaged investment.
That's great. And I know some of the existing opportunity zones, when they came out in 2017, it took a long time to get them up and running, right? What about with the tax law change? Do you already have them up and running? Is there going to be a seasoning process where those need or when does that kick in for someone, I guess? And that by the way, just that 98% roughly tax that's huge for folks.
Yeah.
So, but okay, but back to you. I'm just curious where someone where's that at these days, roughly?
Yeah. Well, but you kind of mentioned a dead zone, and the way the legislation was written, the TCJA was like a 2,000-page bill, and like one paragraph was like opportunity zones, right? So a lot of people missed it in the beginning, and they had to keep updating it. And so to say it flew under the radar in the beginning is an understatement. And so the legislation wasn't perfect. One of the main problems is, remember, you get to defer your original gain, but you eliminate the second gain. And so that deferral, the way that it was originally written, is you get to defer that gain until 2026. So if you invested in 2018, 2019, 2020, that's a long time to defer your gain. Well, if you invest today, you don't get to defer it because you're realizing it in the year that we're in.
Yeah.
So it's kind of a flaw in the way the legislation works. Now, you still get to eliminate all the gains on the back end, so it's still a pretty good strategy. But anybody who's got capital gains is sort of waiting for this new opportunity zone paradigm to kick in. So maybe it's a good time to talk about that updated legislation and the one big beautiful bill and sort of what's happening with OZs.
Perfect. Yeah, we got a little sidetracked, but yeah, launch into that, because that's what I was thinking originally, to prep folks, give them the time to make those, have those discussions, think it through, get to the event a little bit early, get your seat and get comfortable, yada, yada. So go for it.
So a couple things. Origin's one of the larger opportunity zone managers out there. We've launched 3 funds in the last, 6 years and raised about $1 billion of equity from our investors. And so those programs are moving along. But we did just close our last offering. We just closed Opportunity Zone Fund 3. We're not in the market in 2026. We do not have an opportunity zone because there's really not a ton of demand. Now that's pent up for 2027. So we'll be launching OZ Fund 4 January 1st of next year. The couple major changes to the legislation, and I'll just start with the one that I addressed earlier on OZ 1.0. Instead of making it sort of like this brick wall where it's like you have to realize your capital gain in 2033 or 2034, they just got rid of that whole concept, which was not a good idea in the first place. And they went to a rolling deferral. So if you invest in 2027, you now have 5 years. So if you invest in 27, you get to defer your gain until 32. If you invest in 28, you get to defer your gain until 2033, et cetera. So no matter when you invest in the OZ, you now have 5 years to defer your gain, 6 years to pay it. Because remember, you pay it the next year. The other benefit you get is you get to reduce what you owe by 10%. It's a permanent exclusion. So if you had a capital gain in 26 for $1 million, you can invest it in 27. You wouldn't actually realize that gain until 2032. You would pay that capital gain in 2033, and you'd pay it at 10% off. So if you owed a $300,000 gain, you'd actually end up paying $270,000. So with time value of money, that's extremely powerful. Pay later and pay less. That's what we want to do. You still have the 10-year benefit. So after 10 years, your capital gain is completely excluded. Your cost basis steps up fully. And then they are redrawing some of the maps right now. So think about opportunity zones as their actual geographic locations. You can go on Google and just search opportunity zones near me. And you'll see that there's almost 20% of the landmass of the US is sitting in an opportunity zone. It's a lot of them you look at and you go, man, I'm surprised that's an OZ or what have you. So they are going to update the maps. They're adding some things like rural opportunity zones. That'll be for kind of small developers. We're not going to be doing any of that. But the 5-year rolling deferral, the 10% reduction in what you owe, and then keeping that permanent exclusion. And then the last thing that I'll mention is it's now been codified. So in the past, it's sort of sunset. And we were like, this is an idea we want to try. Now it's part of the actual tax code and doesn't have to be updated by Congress. So this is here to stay. I think opportunity zones are going to be a very commonplace investment in 2027 and beyond.
That's really interesting. And let me make sure I get it or listeners get it. Starting in 2027, you're saying someone can put some funds in this if they hold it for 5 years. Basically, the rough expectation is like maybe that 6.5% yield that has a very large portion that's tax deferred, making it maybe something like a 10% equivalent. And then the capital gain, it goes away. Is that's what you're saying? Is that okay?
Yeah. Well, you have to think of it like a ground up development, and just to use kind of simple phrases. Imagine if you were building an apartment building in your hometown. So not much happens for the first couple of years because first you got to dig a hole and entitle it. And so you really see no cash flows for the first 4 or 5 years. But then after that, you see a lot of cash flows because the first thing that happens is you take out the construction loan and you refinance it with permanent proceeds. So the delta between those loans is a cash out refi. Then the properties start cash flowing because you have tenants in them paying rent, et cetera. And then 10 years from now, when you sell it, you get that back end sale proceed, which is, a significant part of it. All of it is tax free. The refinance proceeds are tax free. The sale proceeds on the back end are tax free. And then the cash flow is actually tax free. Here's why. Normally, real estate is one of the most tax efficient vehicles for one major reason: depreciation. And if you think about a normal business where you own equipment and computers and cars and you depreciate those assets, they go down in value. Eventually, a computer's worth zero. It's like a paperweight.
Right.
Here's the interesting thing about real estate. You get to depreciate the asset on paper, but it's actually appreciating. And so while these buildings are going up in value, you could take all of the income that you earned and just from a tax perspective, you write it off. Now, in a normal real estate, you recapture that as a depreciation recapture tax.
Mhm.
It's 25%. It's a very significant tax. But if you think about the way an opportunity zone works, you shelter it, but then you step up your cost basis fully on the back end. So all of that income is not even tax sheltered income. It's actually tax free income.
I mean, that's really compelling. Those first few years when you're maybe not getting the cash flow, though, that's seeding that initial 5-year period, right, of the ownership. And I'm just thinking some of these highly successful stocks, tech space, NVIDIA, Broadcom, they may not offer much of a yield or dividend anyways, right?
Mm-hmm.
So that's really compelling to consider. Or for, I hear a lot of stories of, I was just in a professional meeting last Friday with a bunch of attorneys and real estate people, and they were just bemoaning the challenges of kicking out renters that are horrible. I'm in California. The laws are so skewed towards the tenant if you're a property owner.
Yeah.
Repeated stories of insurance going up 10x. Someone who was paying 30 grand is now paying 300 grand. Reports of a guy who owns apartment, hate to mention names, but one of the largest property insurance firms in the United States, canceling out virtually the whole apartment sector, 41,000 apartment properties in California. I mean, stuff that's, does not make it compelling to manage these things. So, but you guys do it professionally. You're seeing opportunities all over the country. What about the changing of the lines? I know I'd had a discussion with this last year with the client, and he was really surprised to hear a property that he was familiar with in Dallas in a very upscale neighborhood was considered an opportunity zone.
Sure.
That may be going away, but obviously, what's your thought on, will these still be attractive areas? I'm sure that's your job to look for those, but you'll find compelling opportunities in a portfolio, or you wouldn't go into it, I guess. But I just curious, with the lines being redrawn, what you're thinking around that.
Yeah. I'm really glad you asked that question. I mean, Origin, we pride ourselves on our track records. And so we've really had great outperformance. We're a very data-driven company. We think about all of these markets and where we should be located. We've got heat maps and proprietary predictive rent models that helps us choose where to be. And then we're embedded in all of our markets. So obviously, they're changing the zones. Like some of them are really nice. Like, you're surprised. Like I said, why is this an opportunity zone? Well, they used to be able to go up to 80% of adjusted gross income. And they also had what's called a congruent track. So if you're touching an 80% of adjusted gross income track, you would also qualify. So 80% of AGI in very, very high-end neighborhoods is still very high income. So they're actually lowering that to 70% of AGI, and they're getting rid of the congruent tracks. That doesn't sound like a big difference, but it actually is. There's a lot of zones going away. The nice thing is we've got it all mapped already. Now, we don't know which zones will be OZs because that's up to the 50 governors to pick. That'll be kind of summer of this year that'll sort of happen. But I will tell you this, there's nothing at Origin, at least with us, where it'll ever be the tax tail wagging the dog. Like we're not going to look at a deal and say, well, it's a B plus, but maybe with the tax benefits, people will like it. No, I think once we look at the OZs, if deals don't pencil, we just won't launch Fund 4, I don't think. The nice thing is, you think about these apartments, they're significant size. I mean, the checks are probably $50 to $80 million. So we probably put 5-6 deals in a fund, right? So at the end of the day, you think about these tracks, we have 14 markets that we focus on. I'm taking a guess here, but there's probably 500 opportunity zone tracks that we're looking at in those 14 markets. And so it's very much, what does your funnel look like, right? So if we're looking at 2,000 deals a year, and we're going to close on 5 or 6 of those, like that's a lot of scrutiny to sort of get through on the OZ side. So yet to be determined with the governors picking the actual opportunity zones, but I think we'll find some good deals even with the new maps.
Gotcha. So as we're kind of continue through this, a couple thoughts. I wonder if there's any other key provisions coming up in 2027 that we really haven't covered that might be important for people to know. But also another is giving some examples of folks who've gone into this or where it would be attractive. Maybe give an example. This person in Texas put $2.5 million of Broadcom in. This real estate investor did that. Maybe just some examples. And then, it's interesting. So real estate could become that portion of a portfolio, and what percentage should that be? It sounds like you think it'll become a more attractive asset class for a lot as part of someone's overall portfolio. So I probably broke the record for wrapping the most number of questions into one run-on sentence, but maybe you could address those.
Yeah, I think the term solution is overused. This really is a solution for clients out there. Depending on your net worth, like you don't really need creative products, but the more capital that you acquire, the more things you own, the more you need sort of solutions to protect you from taxes. And so, one thing I found is a lot of times spouses work at the same company. Maybe they met each other there, but a lot of times I'll say like, I've got X amount of Microsoft stock, and my husband has the same amount. We both work there, and like that's a lot of Microsoft stock or Nvidia stock. They're great companies, but you don't want to have all of your eggs in one basket. And the problem with unwinding it is it's gone up in value so much that it's just going to create a huge tax liability for you. So there's other strategies that Rob can help you out with in terms of unwinding concentrated stock. But one of them is, as you become a higher net worth individual, you start thinking more like an institution. What's the difference between an institution and a person? Well, a person with lower net worth, you need liquidity all the time. You need all of your assets liquid. And so what that means is you're paying a liquidity premium. You're paying more to have that benefit of liquidity. Once you look at your portfolio and you say, well, I've got buckets, I've got my 6-month cash, I've got my 3-month bonds, I've got my 5 and 7 year. Once you have long-term capital that you don't need to touch, and you're probably going to give it to a charity or your children, like, why would you keep it liquid? So your portfolio starts to change as you get a higher net worth because your stocks keep going up in value. So all you're really doing is sort of selling your stock and rolling it into real estate, not tax-free, but in a very, very tax-efficient manner. And then that real estate is almost the perfect investment for retirement because it's great at preservation of capital and tax-efficient income. We pay on a monthly basis, so it's nice mailbox money for you down the road. And then the other big one for us is just private business sales, people that are having exits. So you basically go from being asset rich and cash poor to the opposite. And now it goes really back to that institution. Now you are an institutional investor. If you sell a business for 20 million, 50 million, 100 million, you're bigger than some pension funds, right? So how do you think about that? Well, pension funds will invest up to half of their assets in what we call private markets. So real estate, oil and gas, private equity, et cetera. And they're typically 8 to 12% real estate allocation. So all you do in that case is you kind of say, well, I know I'm going to buy real estate anyway, so let's just take X% of my sale and let's put it into this opportunity zone. Now I have real estate exposure. One other thing that I guess I would mention, it's kind of like a caveat to your question, is that you get a little bit of extra time if you're selling a business. So I mentioned earlier, you get 6 months. So think about if you want to get an OZ 2.0, anything you sell July 1st or later this year, you can invest it in January, right? It's 180 days. So you can invest it in the next year. So what do you do for assets that you sell today? If it's a business, you can start your 180-day clock when the year ends. So if you sold a business in January, February, March of 26, you can start that 180-day clock on December 31st of 2026, which then allows you to invest in that new OZ paradigm going forward.
That's great. So even a business, right? A business sale of that enterprise value, and then defer that or avoid that capital gain and turn on a later income flow, right? That's very, very powerful. That, so many cases we see concentrated positions that's easily someone's largest asset, right? Or very, very significant. The growth of a business.
Yeah.
Met a couple in Santa Barbara about 2 weeks ago. He had worked for 2 years for SpaceX and received some stock. Well, he's there 2 years. It was a really substantial position when, the folks who, again, with your stock, right? I see it all the time. The Microsoft, the Broadcom, Nvidia, employees or folks who were there. They just keep growing. And then that tax, that unrealized gain, it just becomes a larger and larger swelling problem from a tax. And, if you're in your 40s, 50s, or 60s or nowhere near passing without a step up, it's going to keep growing and being a great issue, but maybe you want to take care of that. This is really exciting. Anything else we haven't covered that you think's really pertinent? We're just trying to let folks know that this is out there and we can have discussions, and we'd be happy to do that. But anything else? We haven't touched on.
One thing I would say, Rob, is that a lot of times when people hear about these solutions, the first thing that pops in their head is like, oh man, this is complicated. And I think when you unpack some of like the tax law and how it works and this and that, it might sound a little complicated on the surface. I will tell you, 1031 exchanges, if you've ever participated in one, are much, much more complicated. You have to use a qualified intermediary. You have 45 days to identify. It only applies to real estate. You have to match your debt. So the nice thing about opportunity zones is how simple they actually are. Like once you understand the process and how it works and you decide you want to move forward, the flow chart is like this. Do you have a capital gain? Yes. Okay. Then you can invest up to that amount into an opportunity zone fund. That's it. And at Origin, we have, I think, 4,500 individual investors. We have over 120 partners like Signature Estates that we work with that invest clients' capital with Origin. So we've got a full investor relations, investor servicing team that's at their desk all day talking to investors. So once you decide to move forward, it's a subscription agreement. All the documents are sort of DocuSigned, and then you're in. And then, we're very educational. We sort of lead with that side of it. So when you're in Opportunity Zone Fund 4, for example, going forward, like we'll have a quarterly webinar on that with the acquisitions team. We'll have videos of how the projects are coming along. So it's pretty simple to invest. You always kind of know what's going on with the assets. Yeah, it's really, I know that we maybe unpack some nuanced tax stuff, but it's a pretty simple process once you decide to actually move forward.
Oh, that's terrific. I love this discussion. I love that we're bringing it up now. You even brought up to July 1. Folks, by the time this comes out, I think the big takeaway is we can entertain discussions. We could have Michael, people from his team, available, I'm guessing.
Absolutely.
I can be involved. We can get someone's CPA or tax preparer. We now have a head of wealth planning and estate planning, came as the head of doing this for Fidelity for some very, very high net worth, where we can do complex financial planning projections, but also estate, please, an attorney. That kind of resource we can put folks in touch with. And these sometimes higher net worth or just folks that might have been blessed to work at a place like Microsoft or Broadcom or NVIDIA that are all of a sudden might have a really large oversized position. They're looking for solutions and strategies, and we have there's a number of them, but this is a really core one that's going to get very attractive, it sounds like, in next year, 2027. So we just wanted to flag that early for folks and start to have those discussions, because most of the folks I encounter in this kind of process, they've been dealing with this over concentration at large appreciation and tax for a long time. But it keeps growing. They don't have the solution. It might be 2 or 3 strategies you put together, but this could be a very relevant one. So we just wanted to flag it early, and we really appreciate the partnership with you and Origin and folks like that can help us think this through and spend a good amount of educational time with folks and their other professionals to say, hey, this is a good choice for you. This is going to, or not. So that's great. And I'm thinking of you guys, in July with the governors, kind of like thinking of the NBA, or what is it called? The NFL draft. You know how you sit there and watch and you guys are, hey, look at this. Look at this. This one just came into, that might get a little interesting with November elections and some governors. And I don't want to, that's a different pay grade that I'm used to, but I'm just thinking aloud. So great. Any final closing thoughts? But hopefully folks get that this is a resource. I'll be sharing it with folks, with all of our clients. And if you do find yourself in this situation or know someone who is, we just want it to be an evergreen resource as an education. And we'd be happy to obviously don't do this on your own.
Sure.
Get some professional guidance.
Yep.
And because you've made it simple, but that doesn't mean you're an expert in it, someone who does it every day. And so we can pair those resources. But yeah, I'll let you have any final closing words if you like, but I really appreciate you coming on. This is great.
Yeah, Rob, I think that's it. We covered quite a bit. I think the idea here is that it's a niche sort of tax strategy. It is a solution. So if you're worried about something like we have too much invested in this one particular stock, or my business is going to sell soon, or this real estate that we manage, who's going to run it when I'm gone? I don't want to sell and pay taxes. Like, this really does solve problems for folks out there. So we're happy to discuss individual cases one-on-one and just be a resource where we can. That's
fantastic. Yeah. So I really hope to have those kind of cases and work through solutions for folks. And, we're approaching 2027 pretty fast. There's a great rock song. He says, time keeps slipping into the future. Well, we're going to be there before we know it.
That's right.
And even that July. So this has been terrific. Again, super appreciate your time. Thanks so much for listening, folks. Please like, share it, and listen to future events. We've got a lot of really good stuff coming up in this year. And thanks for being here, and thanks for joining us, Michael. Appreciate it.
Awesome. Thank you, Rob.
Thank you for listening to the Millionaire Next Door Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors or Royal Alliance Associates Incorporated, member FINRA SIPC. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
All investing involves risk. Past performance does not indicate future results. Specific products discussed are not suitable for all investors.